I'd like to say welcome to the first of the lunch series that we've put together on building wealth as a business owner. So I guess my role at iKeep, which is the bookkeeping and back office division here at Chadwick, every day of the week, we're trying to help business owners inside their business. Usually it's from like an automation perspective or just making sure the regular basic compliance is taken care of. But once you get that right, you've got to go to ultimately to the end. It's like, how can we actually help the business owner even further? And I mean, there is so much hysteria in the media about whether it's property going up, crypto crashing, or stocks and the like. So over the next couple of months, what we're going to try and do is unravel what's actually going on in each of these different investment classes through speaking with our friends who are experienced experts across all of these different areas to just unravel and simplify what's going on. As a business owner, a lot of our clients, and like even myself included as a business owner, are very time poor. So we're going to draw on the experience of professionals like we've got here today to unravel what's happening, how do we maximize the value inside your business, and how do we actually ultimately maximize your wealth as a business owner. So we kick off today with the first lunch session with Chris Gray, the founder of Your Empire. Now, Chris would probably be familiar to a lot of you. He's regularly called on TV to be the property expert on different programs, even had his own show, Your Property, on the Sky Business Channel. Chris's property journey started when he was just 22 years old with a $35,000 investment while he was working at Deloitte as a good accountant, but through first-hand experience, unlocked a way to how to affordably make a property portfolio as an employee a reality. So we're going to try and unpackage how some of that happened in our conversations today. And I've got David Kenney with us as well, who's a partner here at Chadwick, partner in business services. And David has many years working with startups, scale-ups. So whether it's last week interviewing Jindu Lee, who's just raised, was it
$72 million?
$72 million. So literally going from startups who are working.
So he now manages 1 in 8 properties in the US. I mean, that's a lot of properties he's managing. That is an unbelievable business.
But David started working with him before this guy had a cent. So David goes on the journey with small businesses. From very, very small to very, very big. So part of what David needs to do for his clients is actually unpackage how do we structure a deal and how do we extract value out of the business. So on that note, do you want to give us some insight maybe? What are 3 things a business owner can do to maximize the value of their business so that they can recognize their hard work?
Yeah, thanks, Simon. So I think the key thing is really keeping things simple as possible. And I always like to refer to 3 things, which is getting the right product in front of the right customers with the right message. And it all comes back to that. But opening up and developing more value, it comes back to working out what the systems are. I've never seen anyone sell a business and they say, show me the balance sheet. Show me what's on your balance sheet and I'll tell you what you're worth. Because what someone's buying is essentially the systems, the processes and the people, and the mechanisms for how that ongoing regular income is generated each time that gets de-risked. So being able to improve those systems, improve the people, attract and retain the right people, these are some of the things that go to creating some value, and that creates that repeatable revenue. And that repeatable revenue can be used to grow and reinvest into key things and either more sales and marketing or more administration or more product, next product, etc. So some of these things allow you to create some value, and then from there that value can be taken off the table through either dividends or salary. And there's obviously a whole bunch of different rules around watch outs with loan agreements that need to be put in place, how much tax am I going to pay, and also, and one of my real bugbears is that a lot of people are shooting themselves in the foot because they're not thinking about how do I actually do what really matters, which is growth, without taking as much risk, and that is being able to borrow money. And a lot of, I think, the mistakes that people think is that a good accountant is someone who just helps you pay no tax. A good accountant helps you grow your business to go overseas, to grow and be sold eventually. So being able to show people why you're worth investing in through debt or equity That doesn't happen without those systems. So you can't turn up to a lender or a great broker and say, can you help me grow my business? I've got a great business, and you've got nothing to show for it on the profit and loss on the balance sheet. So you've got to get all of those things right. So to be able to take money off the table and do it regularly, but also to let other people provide you with cheap capital and debt so that you can actually take your business to the next level, because you've got your people, your processes, and the mechanisms in place to grow. So they're some of the key ones, I think, Simon.
Yeah, okay. So let's just say you're a couple of years into the business now. You've got your people, your processes, and your product all sorted. What are some of the different ways that a business owner could extract some of that value they've created outside of the business? Unfortunately, it's not as simple as just doing a transfer from the business bank account to your personal bank account to then buy property. And there are lots of different pros and cons, whether it's equity or debt. What are some of the different ways you could recognize value if you've spent years creating a business and building a business up? As an owner, how can you get some off the table?
Well, I think there's a couple of key ways. And whilst being able to take money off the table, you need to think about, should I take the money off the table because is my business growing and does it deserve that capital? But assuming that you've got surplus funds and you've got free cash flow, then taking it off the table can be, as an owner, more salaries. But bear in mind, as you pay more salaries, there's lots of different implications from that. One is if you're trying to sell your business, you're looking at what your arm's length salary is, and that's going to, if you're not paying yourself enough, you're then going to be penalised when it comes to selling your business, because your salary should be higher, and that will push down the value of your company through the normalised earnings being a lot lower. So your multiple of earnings will be lower in overall valuation. So I think one of my favourites is really looking at, staggering the payment of loans to people and then letting the income tax catch up so they can then declare a dividend. You might as well look at other ways of taking money out and even taking loans out and looking at whether or not you can have enough security on the loan so that you can pay that off over a 25-year period instead of immediately tomorrow, or having to pay it back at the end of the financial year, or having to pay it back over 7 years. And understanding the whole menu, Simon, I think is important, being able to look at, well, what's my forecast revenue going to be? How much am I going to generate next year? Am I growing? Am I going further forward? Am I coming back? And where should I be taking money off, and how? I think most people, and this is not a reflection of, I guess, good or bad, it's just that if you don't have that data and know where you're going, and that's why what Simon does is so important, because it forces you to get a little bit intimate with your numbers, not being becoming an accountant, but an intimacy around how your business works and if I put $1 in my company, do I get $6 out? So when I put money in, what is my revenue engine? And I don't think anyone I meet ever understands how to put together a revenue model. They say, here's what I did last year, I'll do it again next year, and here's my costs. That's not a revenue engine. A revenue model or engine is something that understands how you win customers, what activities there are. When you put those ingredients together, you get that $6. So you're really building up the knowledge around how your business works, almost like building a digital twin of your business to know how, if I put more money in, what will I get out of that? And so being able to do that lets you understand the ebbs and flows and whether or not you're going to hit the accelerator or slow down, and be able to work out what your free cash flow is so you can take that money out. And so you're not then taking it out and thinking, oh no, I haven't got enough for this. So it's being able to have a good dashboard of understanding what your revenue model is, what your dashboard looks like in terms of how much is left in your tank, and whether or not your company deserves that capital, and if it's still growing and it's being deployed properly, because you're getting 6 for every dollar. Every dollar you put in, you're getting 6 out. That's a good ratio. And there's lots of really good ratios that we can embed into your systems that work out how much and how fast you should be spending and when it's time to take some money off the table. Because it will be time, and doing that regularly is important, but having the right information around you to work out why it's time to take it out. And how much should you be taking out? And should you be paying yourself first?
Yeah, good points. Good points. I think it's time for a story though. I mean, a lot of our ambitious business owner clients that we work with tend to love having multiple entities, one for this, one for that, a family trust, a operating company, a self-managed super fund. Do you have any war stories from someone who's purchased property in the wrong entity and what the implication was for them not actually thinking it through in advance?
So many. I mean, the classic cases everyone might have heard of is people buying, the ski lodges in their super funds and turning up and having to pay half of the value of the ski lodge to the ATO, buying properties that are going to go up in value in companies. When you don't get a discount capital gain, and then you ultimately pay 47 cents in the dollar, which is crazy when you can only pay 23 cents if you structure correctly. And one of my favourites is really understanding, how do you combine your commercial operations, your property for that, and also your business, and being able to structure that so you can also get a discount capital gain and possibly also get a further discount gain if you sell your business, or even if you don't sell your business and you sell your business premises, and getting the tax on your business premises down to zero because you're either retiring or you're selling it and you're under the thresholds for the small business capital gains tax concessions. I love it when people can, say, and I think I've done this to people in the room actually. I've said, guess what? Your tax rate is zero. And they go, oh, bullshit, you can't pay no tax. So I said, you can pay no tax. So, but you've got to make sure it's in the right structure. So getting a great outcome will come down to being able to anticipate what you'll use the property for, how it'll be funded, because it's all very well to fund it out of the company if you're putting it in a trust, but you then got to think about, well, hang on, if I'm funding all of my equity out of my company, now I've got a loan to my trust. So it's a very peculiar set of questions that you've got to go through to work out what's my current use, how am I going to fund it, how much equity am I going to have, and what's my right gearing level, and what am I going to be able to do with that property after? Can I gear it? If it's in my super fund, no. Or if it's in a bare trust, yes. So it depends on how fast you want to grow and what your free cash flow is. And that's why the business is, I know Chris will say you can make a lot of money in property, and I 100% agree, but I think for people that are running a business, it goes hand in glove with running your business and making sure that you're getting enough return out of your business as well as taking money off the table. So getting that right looks like magic.
Yeah. So in a little bit of a segue, do you think having an ambition to have a property portfolio is mutually exclusive to having a high growth business, or do you think they can actually run in harmony?
Well, I think they should run in harmony, and it depends on where you focus your time. I've had several exits with clients. We've sold businesses. At one stage, we got one away last year that had a market capitalisation of $8 billion, and these founders then said, who probably had one or two properties at the time, said it's now time to gear up. We want to buy 20 properties. So getting very wealthy does tend to change your risk profile in some ways, and I don't quite understand that, but you definitely can make a great property portfolio from focusing on how you predict and create more predictable growth engines, and know that when I put money in, I'm going to get that $6 out. And so when you get that $6 out, you need to work out, well, how much I'm going to have to pay to the tax office, how much am I going to put into property and or shares, and what will that do over a 20-year period? Because you don't want to just be thinking short term. You really need to think with property and your business in those two different timetables. When can I get it to a point that I can sell it? When does that then mean I'll buy an even bigger property portfolio? But I'm a big believer in saying I want to run both. So you need to get enough free cash flow into property or shares, enough reinvested into your company. But again, you need that dashboard so you can say, I know that I'm getting my $6 out, so I'm still doing the right thing with my property, with my business rather. I'm investing, I'm making it work, I'm getting the right results. because I've got the right team around me. Speaking of team, that is one of the things I wish I'd said about how do you create a good business and the value. The right team around you. It's really hard to attract and retain good people at the moment. So getting them in the process, learning, and I can see a couple of people in the room here that are in my team, which is great. So being able to not just pay people, but learn how they can learn how to get better at running your business so that you can be in some part expendable or have a day off, etc. And so that it's okay for everyone to have a day off. So being able to develop that, that's not accounting, it's not tax, it's not property. It's how do you create value in your business by building the right culture within your business. And these days I get asked a lot more questions about hiring people, culture, capital allocation, launching products, sales and marketing. Those are the questions that really, I think, are the key things in terms of creating value, getting those 4 things right. If you get those 4 things right, you're going to create a lot of value in your business. You're going to create free cash flow. You're going to be able to invest, get it in the right structure, and they do very happily exist. Obviously, you can invest too fast or too slow, but having that real clear understanding of how you're controlling your capital and how you're getting better at those 4 things, capital allocation, speed, the direction, the increments of the money you're spending in your business, how you hire. Hiring is a real skill. It's not just put an ad on LinkedIn or put an ad on Indeed or wherever all the platforms are you're looking at. Launching products, not just building it and saying, I hope it sells, and then getting your sales narrative, your marketing narrative correct, and weaving in the numbers. All of these things go hand in hand these days. You don't just say, I've got a marketing person who knows nothing about procurement, or a procurement person that knows nothing about the costs and capital allocation. This day and age, the best people understand these things in a reasonable dose in all areas, and particularly the CEO needs to understand this in a reasonable shape. And that's when you do that, you get through the $100 million revenue barrier. And that's my goal, help people reach $100 million in revenue. And trust me, you've got a unicorn on your hands if you've got $100 million in revenue.
Yeah, that's massive. That's massive. All right, let's shift the conversation a little bit more to the property side of things now. It's like, Chris, one of David's clients has hit the 100 million or is well and truly along the way there. There's a lot of different asset classes out there that are screaming for money. I guess I would love to hear from you. Why should property be one of the things that they consider putting their hard-earned money into?
Wonderful. Well, there's no right answer. So for everyone, it's different things, and it's the classic kind of risk reward and how much time you want to put into things. So probably the main reason I've got into, say, residential property, so I started investing at 22, semi-retired at 31. Now I've got about 20, 25 million of property. The reason I got into resi is you don't have to be that clever. And I wasn't that clever. And so residential property generally doesn't change. So today I'll use the example of Bondi just because everyone knows it. So if you've got a 2-bedder in Bondi worth 1.5 million, that's never changed. You can't create any more 2-bedders in Bondi, give or take, or in Manly or Balmain or something like that. And so the biggest thing I learned after Sky News doing like 400 or 500 interviews is the main thing is it's supply and demand. If there's no more supply of a product and there's plenty of demand, prices go up. And so Bondi property typically, through recessions, through COVID, through, I guess, credit crunches, all of those kind of things, it hasn't really changed. Just like properties in London and things like that. Whereas as soon as you get into something like commercial, the main value I see in commercial is when you haven't got a tenant, because commercial is generally valued by the future revenue of income coming in. And then you can put a blue chip tenant in there, you can really increase the value. But you get something like a GFC, and then suddenly the whole sector could go down. Or you imagine CBD commercial at the moment with COVID, that could be massively affected. And so this is why I think residential versus commercial property or industrial property or getting into a business, you don't have to deal with tenants, you don't have to deal with, or you've got to deal with tenants, you've got to deal with, you haven't got staff or stock or anything like that. So my portfolio probably takes me about an hour a month to look after. So about 12 hours. So, because you just delegate out to property managers and they're all on 12-month leases and stuff.
Makes sense, yet the news we've got in the markets at the moment, interest rates are potentially going to rise, homeowners going to be squeezed on mortgage payments. Is that then going to create a decline in the market? What are your thoughts with all this hype going on at the moment of what the market will look like and whether property is a good investment for someone in the next 12 months?
Sure. So the first thing I learned in wealth creation was don't listen to the media, don't listen to your parents, don't listen to your friends and colleagues and the rest of it. And again, after doing 10 or 12 years on Sky, I wouldn't listen to a word of that either. And this is probably why I didn't have the highest rating TV show, because I said to people, right, just tune in once a year. I'll tell you the markets are all right. Tune in next year and I'll tell you the same thing. And that's it. Whereas I think on TV shows, they actually need viewers to tune in every week. And that's why we have the current affair things type of programs that say, oh, the market's going to crash or the market's going to boom or all of these massive headlines. Like, you don't need to be a genius to sell a newspaper or a TV show. You've got to come out with a great headline. And just saying that the market's going to be fine, buy Bondi and sit on it for a year isn't really going to sell any papers or anything. So generally, I don't listen to the media. And the second thing is I try and take all the emotion out of it. So I used to be an accountant, and that's a great advantage for property investing. It's not so good when you get married and things like that. You've got to learn emotion, which my wife's been teaching me. But for property investing, being an accountant's really good, because effectively what you'll find, if you read my book, I wrote it back in 2008, and literally we haven't changed a word, even though we've had GFCs, COVIDs, all those kind of things. So what you'll see in my book is I still work out my interest rates on 7, 8 and 9%. Because if it works at 7, 8 or 9%, it definitely works at 2 or 3% that we're getting at the moment. And so the whole thing is to treat property investing as a spreadsheet and treat it as a business, take the emotion out of it. So again, you were talking about businesses and property should be a long-term thing. I'm thinking 10, 20, 30, 40 years for my portfolio. So I know interest rates are going to go up and down. I know rents are going to go up and down, and vacancy and all these other things. And so what I work out in the book is basically what is my break-even point. So what's worst case am I going to get on rents? What's my worst case I'm going to get on interest rates? And then I work out to have a cash buffer. So if I've got enough cash to last me a year or even 5 or 10 years now, if interest rates go up or down, who cares? And what do? You can fix for 5 years. So if you can't sleep because of interest rates, just fix it and don't worry about it.
Yeah.
And it's like vacancy. I know the vacancy for a 2-bedder in Bondi with parking within a K of the beach and a small block of 12 is 0. Whereas one without parking on a main road with a bad agent that's unrenovated, that hasn't been looked after, is probably 100% vacancy.
Yeah.
So I don't care about the 100, I just care about the 0, the ones I'm dealing with.
Yeah. So that kind of goes back to buying right at the end of the day. If you can get the right thing, then it takes a lot of the stress and the risk out of it. So let's just say it's someone who's looking to get into the property market. I mean, it's a pretty daunting thing. There doesn't seem to be anything in Sydney under $1 million. How does someone get into the property market if this is one of their goals? They've started a business. The business is now a few years old. They can slowly get some money off the table. Is it impossible to start a property portfolio, or how is this done? What's a strategy for someone to get in?
So look, the biggest thing is to have a dream. And it sounds like an arty-farty kind of emotional kind of thing, which obviously an accountant's not really into, but that really makes the difference. Is if you're driven, if you've got something to go for, because otherwise property is always going to be too expensive. I had old bosses at Deloitte that were in their mid-30s earning 200 grand a year that still couldn't afford to get into the property market because they were flying business class, then they lived in a nice place, they went on nice holidays and they did all this stuff. They've got no money. Whereas we've got a guy that we've just hired who was 21. He was at university working part-time in a pub. He bought a 50-50 property with his cousin. He bought a 750 grand 1-bedder in Vaucluse, so 375 grand mortgage each. And he bought that at the start of COVID when no one else was buying. That 750 is already probably up at 9 or 950. Last year at 22, he bought his second property, 100% by himself, an 850 1-bedder in Cremorne. So if a 21-year-old can do it, sure, you get some of the skeptics out there saying, oh, he lives at home, it's all right for him. But again, people said, oh, it's all right for you, you're an accountant. Yeah, but I worked full-time at 21, went up to London to night school 4 nights a week, then studied at the weekends. Yeah, I was pretty lucky. but it was bloody hard work.
Yeah.
And then I had to study at the weekends and property invest at the same time. So if you need to get 4 or 5 jobs, go and get 4 or 5 jobs. If you need to go and cut on your expenses or move back in with your parents or move in with a mate, go and do it. You don't have to do it forever. You've got to do it long enough to get that bank approval to then get your property over the line. Because one of the chapters in my book is called "It's not about what you earn, it's what you do with the money that counts." So certainly around the accounting things at Deloitte, there's people earning 500 grand, $1 million, that kind of stuff. The biggest salary I ever earned before retiring was basically 80 grand or 60 after tax. But in 2000, I had 6 properties making 600 grand a year. And I wasn't selling, so I wasn't paying any tax. So do you earn 600 grand for doing sod all, or do you earn 60 grand for working 40 hours a week? I chose the 600 grand. And I thought there's a better way.
Yeah, fair point. And so sacrifice for a small amount of time is I guess the summary of the strategy. Sacrifice with a clear goal in mind to figure out, sacrifice now for benefit in the future. Now you're pretty well known for a strategy called rent vesting. Do you want to just discuss that for a minute and who that's appropriate for?
Sure. So yes, it is all about sacrifice. So look, at 22, I bought, rather than borrowing 3 times my income, I borrowed 7 times my income. So I could afford a 1-bedroom unit, but I worked out if I could buy a 3-bedroom house, I could actually rent out 2 rooms to 2 mates and actually live for free. And I ended up buying a 100 grand property for 80,000, so I made 2 years' salary overnight. So the main thing again was taking that emotion out. My sacrifice was being so highly geared from the age of 22 was massive, but I just knew even though I was highly geared, the numbers worked out, so it didn't really matter because I had those rents coming in as well as my salary. 2 years later, I worked out how you could refinance and I got a free Porsche. So I had a free house and a free Porsche by 24, and it's all basic numbers. So move on to the age of 31, I suddenly found out that lots of these wealthy people around Sydney aren't buying these luxury penthouses around town, they're actually renting them. Because let's just say you've got a 2-bedroom Bondi, middle of summer, close to the beach, you want to rent it out, how many people are queuing to rent that property? Quite a few?
It's big.
So what happens to the rent? Goes up when you hear about these Dutch auctions and stuff like that. Whereas if you say wanted a $5 or $10 million house, how many people are queuing up to rent one of those? Because how many people can afford the rent on a 5 or 10 million? Not many, so what happens to the price? Goes down. Now, even the ones that can afford the rent on a $5 or $10 million home, how many of them want to rent?
Not many.
Not many, because poor people rent. Isn't that the stigma in Australia? Poor people rent. So if the boss of this firm or the boss of Macquarie Bank, he was known to rent, most people would say, well, you can't even sort your own finances out, you're a poor renter. So the price keeps going down. So effectively on these little 2-bedders, you get between, say, 3 and 4% rent. The rent on a $5 or $10 million home is about 1%. So I worked out whatever I could afford to buy, I can afford to rent somewhere 3 times more expensive for the same money. So rather than say if you've got $3 million, I'd rather buy 3 $1 million units, get the rent in off that, and then use that money to then go and rent a $5 or $10 million home. And a lot of people say, oh, you get moved on, you get kicked out, you can't do whatever you want. We've been in the same place for 11 years. I've drilled holes in there, I've recarpeted it, I've done God knows what to it. And again, we've been there for 11 years. The property managers have moved time and time again. Who knows what it was like because they weren't around.
Yeah. Different set of photos on the check-in to fair enough, someone else's folder. So it makes sense. And David, do you want to speak to that? Because are there instances that if that place that they're renting is ever tax deductible in a business, if it was a home office in the past few years, or are there other things there, or is that pushing the envelope too far?
Well, it's definitely hard to get a deduction for private expenses. So, but yeah, some people are renting and having the classic case is the doctor who has the front part of the house as a surgery. It is hard to get rent deductions for private properties, but you know, if you've got separate quarters and you might be able to, I always say don't be greedy when you're doing things like that, and you might get a little bit of joy. But
Mainly on floor space, isn't it?
yeah, it's on floor space. But again, if you just say, well, I've got this massive place and I'm going to take as 4 rooms, it's complex. But you can do a little bit of claim, but it's very careful you've got to be very careful. Second thing too is if you buy the place, if you're making income on it, then you're going to sacrifice your capital gains tax concession. So it's doing things with property. The law keeps changing in terms of what's deductible, what's our depreciation rates, new properties, old properties. It's just a major fascination for the tax office property and superannuation. So the law is always changing. So I would say just be careful, but just keep buying. Like, don't sell, keep buying, unless you're in an area that has reached its peak, and then
if you don't sell, you don't pay the tax.
You don't sell, you never pay the tax. So you can buy it in a company and say, that's probably the one exception, is that sometimes people say, oh, I want to buy my dream house in this area. And I say, well, you could potentially buy that in the company, but you'd never be able to sell. So there's always exceptions to every rule, but if you're trying to give people as much optionality as possible, you probably want to have it personally or in a trust. But like everything, it depends on the rest of your wealth, the rest of your what are you trying to optimize for? Is it for a tax deduction or for growth? I'm all about growth. I like thinking you start here with being $3 million. By the end of the journey, you're worth 20 or 50. That's the goal, not how much tax you're going to save, not how many properties you're going to have, but how wealthy you're going to be and how clever will you be on capital allocation. How clever will you be on getting the right people around you to help you with these things and help you with this strategy and help you with this? Because that's what it's all about. It's about, to me, winning is just building the growth and making sure that the client is getting what they want. It's not, like, if they don't want a $100 million business, fine. They want to understand and spend more time with their family, well, then learn how to hire people. So it's those 4 things, Chris, in my view.
And look, I think what David jumped on with the accountants was spot on. So talking about how to afford that property, most people go to their accountants and say, I want to pay no tax or reduce my tax. And they say, I've got a good accountant because I pay virtually no tax. Whereas being a property investor, you've actually got to be a contrarian. So I go to my mortgage broker to say, how much money do I need to earn in order for the bank to refinance me, to release equity, to buy more property or to live off? I then take that number to the accountant to say, right, we need to prepare a set of accounts that have got this number at the end. And obviously, we're not doing anything wrong here. And then between me and the accountant, I've got to get the business performing to a certain level, and then the accountant needs to do the books. So rather than necessarily trying to claim every single dollar, it's, well, you can move income and expenses between years legally. And obviously, you want to do everything legal. I was always told that it's not worth the tax audit, because the tax audit will send you bust quicker than anything else in life. So it's about doing it properly. But the accountant that will then actually give you the right tax return to get you the mortgage can then make you hundreds, if not millions of dollars, versus trying to save a few dollars on tax. It's neither here nor there.
I remember back in my early days, it was the Italian cafe owners that had the 3 sets of books. They had the one for the tax office, the one for when they wanted to sell, and then his own set of books for how he was actually doing. It's like, whoa, keep a distance from that. I'm not saying this is anything like that, but obviously having a plan in mind.
With that.
Yeah, you can't do the 3 cases in 0 these days. Unfortunately, it's one or the other. So I guess one of the things I'm interested to understand is we've kind of gone from, like, you've created value in your business, you've got your first property, you've spoken about how location and actually sacrificing to get your first property is really important. Does your strategy change at all as you kind of continue along your way, or is what you're looking for in the first property the same as what you're looking for in the third, fifth, and so on? Does it change along the way?
So look, ideally you review everything, just like you review your business or your marketing plans or your sales plans or anything like that. But ultimately, what I was buying when I was 22 is exactly the same as what I'm buying now. So part of it, I kind of lucked out and got the right kind of strategy. But ultimately, the main strategy for me was not to try and rely on trends or the latest, greatest thing, because then I'm constantly researching, trying to find what is the latest, greatest thing and what's the future going to hold. And I was never that clever. And so my thought was if you go into those areas where there's no supply of properties and there's lots of demand from wealthy people. So I lived in a place called St Albans in the UK, about 20 miles north. It was a conservation area, so you couldn't build any more properties. And generally, most people came from a good family background. They were university qualified and they worked in the City of London. And so they basically had money. And so when suddenly something like a GFC happens, they've generally still got jobs, they've still got money, and that pushes prices up. And so that's why I've stuck with a blue chip strategy. So typically we avoid the CBD, because in the CBD you can keep building these tall towers, and most Aussies don't want to live in the CBD. So we're generally going 5 to 15 Ks out. So think of the eastern suburbs, the lower north shore, the inner west, where most young professional people want to live, because there's beaches, cafes, restaurants, lifestyle. It's easy commute into the city because there's lots of transport. For people later on with kids, then there's obviously the schools and that kind of stuff. And literally there is no more supply. Sure, you see Meriton putting up big blocks kind of once in a while in some of these areas, like the Bondi Junctions, but you can't get that at Bondi Beach or in Coogee or Clovelly or places like that. And so that pretty much is infallible. I don't think it's changed for the last 30 or 40 years, and I don't really see it changing for the next 30 or 40 years. Even though with COVID, we were talking on the news a lot about people moving regionally, sea change, tree change, all of those kind of things. I still think because there's so few properties in those areas, there's still going to be, that's going to be the place that people want to live. And employers, even though you can work from home and do stuff, a lot of people still want to be around the city and have lots of Ubers, Uber Eats and that stuff. Whereas if you're in Byron, you're not going to get that stuff.
Yeah, true. There's a lot of convenience close to the city. Do you think that holds true for any of the capital cities inside Australia, that 10 to 15 kilometre radius strategy?
Yeah, look, I think it's pretty much around the world. Mm-hmm. But obviously, if you get into big capitals like the Hong Kong, Singapore's, places like that, because the government gets involved and they change strategies like grants and taxes on having second properties, they're manipulating the market. Whereas I think the good thing in Australia, they're not. But what I'd buy around Australia would be different. So I buy what the median price gets you for that area. So the median price in Sydney is $1 million. That roughly gets you a 2-bedroom unit. If I was in Melbourne, I'd probably go more for a semi or a townhouse. Anywhere else in Australia, then I'll go for a house, because that's what the average person lives in and that's what the average person wants. So Sydney and Melbourne, I'd say that's roughly about the same. Like, there's no supply of property, there's plenty of money in the rest of it. So if you're from Melbourne, look, chances are you're going to spend more money down in Melbourne. If you're from Sydney, I've got all my money in Sydney apart from 2 in the UK. But I think once you go to places like Brisbane and Perth and Adelaide and Canberra and stuff like that, then you are reliant on less industries. And so it is going to be much more volatile, and potentially you're not going to get as much growth. And so for, say, something like Perth market, you'd have to time it. And then that's suddenly get into speculation. And that's what I think is really, really hard. So quite often we say our strategy is too simple for most clever people. So when we're speaking to a bunch of accountants, at Deloitte or at CPA Australia or something like that, most people are so clever, they're trying to say, no, I want the latest, greatest thing. What's the next thing coming up? How can I time the market? Whereas there's nothing wrong with just buying and holding on forever. So for a lot of people, they want high capital growth, they want high rents, they want cheap interest, they want easy to borrow money from the bank, and they want easy to find a property. In the last 50 or 100 years, do you reckon we've ever had those 5 things? Never. Will we ever have them? Never. So I buy when I've got the cash, when the bank lends me the mortgage, and when I've got enough cash buffer to last me for 2 to 3 years to make sure I'm not forced to sell it. And that's as hard as it gets.
Yeah, right. Okay. So let's say you are planning out your property portfolio or the next property move. How do you distinguish between the capital growth you're looking to get and what a fair rent is? Like, I assume with the rent, you can do a pretty easy look at what other people are paying in the market for a property priced like that. But how do you slide the gauge on capital appreciation versus rent on a particular property that you're looking to purchase?
Yeah, so most of the ones we're looking at, it's generally going to be pretty straight. So most of the rentals now are going to be about 3%. Some might be 2.75, some might be 3.25. And that's basically the rent per week times 52 weeks divided by the property value. Okay. A rental that suddenly gets 3.25 isn't necessarily better than the one gets 2.75 because it may just need a lick of paint or some renovations or something like that. But really what we're thinking about is we're thinking if we buy $1 million property in Sydney, assuming we're borrowing 100% of the money and the stamp duty, it'll probably cost us 5 or 10 grand to hold that property. So that's the negative gearing. So you're almost having a forced saving of $1,000 a month. But ideally, we're trying to think that it's going to grow by 50 or 100 grand. Yeah? So that's roughly a 1% break even. If the property market goes up by 1%, it goes up by 10 grand, you've broken even. If it goes up by 5 or 10%, you've made 50 or 100. Whereas if you bought interstate, so up in Queensland, that property might actually give you 10 grand in your pocket, but it might only grow by 50 grand. So if you're on an average income, you can't afford to be negative geared, so you'd go for that Queensland property that makes you 10 grand plus the 50, i.e. 60 grand. Whereas if you're a high income earner in Sydney, ideally you'd rather lose 10 grand, which you get a bit of tax back on, to make the 50 or 100, which you don't pay tax on if you don't sell. And that's really the bet. So how long can you keep paying that 10 grand until you get the next boom where suddenly it goes up 20 or 30% overnight? And that's effectively the gamble.
Okay. So it is a property by property decision as to where the scale is on the capital versus the...
So again, is buying those two bedders or that million and a half range, you're going to get 3% rent and ideally 5 or 10% growth. If you got into $2 or $3 million homes, you're only going to get 1 or 2% rent, but you might get 10 or 12% growth, but it will be lumpy. And then if you got into a little studio for maybe 700 or 800 grand, you might get 4% rent, but again, you might only get 7 or 8% growth. So that's the scale, and the middle level is about 1.5 million.
Yeah, okay. Makes sense. Before we open to the floor with any questions, may I have?
We've spoken a lot about residential property, which is one of my favourite portfolio items as well. But just wanted to mention that commercial property and being able to raise money from other investors as well, and then leveraging that and being able to revalue the asset and taking that money out from the unit trust, for example, tax free. That's possible, and we've worked with lots of people that have gone in and bought $30 million properties with a few investors. It gets the asset performs, business performs out of that asset, revalues to 60 from 30, take out all of your equity, do it again on another site. So that can be done without paying any tax. So understanding upside from that property, how you're going to leverage the business and grow the property value and take the money out and buy another one, so then you can buy some more properties and some more residential as well. This is all a capital allocation question. How do you understand all of the rules around how the banks work, how tax works, how you can take the money out, and how investors work? Those are the things that I think are important to do. And I guess the last part is understanding you've got to be patient and being who you get your advice from. I spoke to someone on my drive-in this morning who missed out on buying the place that his premises he was operating out of, the heartland of his business. He said no because his accountant said, "Oh, look, what if something goes wrong?" And he missed out on this factory in the West. And that factory he's now moving out of. It's gone from, he could have bought it for 3, it's now worth 10, right? And that's only over 5 years. So he's now got to go and move his office, move his manufacturing facilities, because the accountant said, who probably didn't own a damn property, said, "Oh, that'd be risky for you." So, and I'd like to say that and this is something Chris said, which is that things might change, but fundamentals don't. So even in GFC, even in COVID, everyone works something out. So not investing, I think, is the key real risk. Attacking smart with good people around you that understand what risk is and how it should be mitigated and how to grow and combine your capital allocation so you're getting it from the right pots. That's critical, not just saying, don't do it because it may go wrong. That is an absolute disaster for thinking, let's wait and see what happens in the rest of the world. Are we going to be in war? Are we going to do all these sorts of things? There's always something. And that's, again, why you probably hate media, because I hate them too, because they just tell everyone that this is going to happen, or that's happening, or this is going to happen. Well, you're not in the right suburb. We've just got this overwhelming amount of crap coming at us that stops us doing smart things. And the fundamentals, I agree with you, Chris, don't change.
Probably another quick example of that. So in 2017, we had the last property boom. So no one was buying in the last half of 17 because they say it's going to crash. So in 2018, they didn't buy because the market was going down for some properties, not all the properties, for some properties. So no one was buying because they said, I can get it cheaper next week, or the week after, or the week after. So it goes all the way down. So they didn't buy in 2018. 2019, I think we had the Royal Banking Commission and we had the credit crunch. Mm-hmm. So then 2019, some people wanted to buy, but they couldn't because there was a credit crunch. The banks wouldn't lend them the money. So they didn't get that timing. So then we get into 2020 and it's just about to start to take off. And then what do we have? We have COVID. And so no one's going to buy in COVID because this is the worst thing in the world. No one's ever heard of it before, just like the GFC. The world's going to come to end. Everyone's going to move rurally and no one's going to have any money and the rest of it. So they're not buying in 2020. 2021, we kind of got over COVID a bit, and then we had that massive year. So people were then trying to buy from February, because that's when the market opens, till about June. So that's literally 4 or 5 months. Once you got past June, people say, it's already risen 10%. How far can it go? I'm not going to buy now because I'm going to be paying way over the odds. So the second half of 2021, they weren't buying. So literally they had 4 or 5 months to buy. Now we're in 2022. Interest rates are going up. There's still a bit of COVID around. We've got an election. I'm trying to think what are the other reasons. So if you look at from mid-2017 to, mid-2022, the area to buy was 4 or 5 months. But if you didn't listen to that, the properties have risen 300 or 400 grand. So if you were just ignorant and just bought, you'd have made 300 or 400 grand. If you were super cool, yeah, sure, you might have got in for 6 months, but you've probably only made 50 or 100 grand anyway. So just don't time the market.
Yeah, all right. It's the old catchphrase, time in the market rather than timing the market when it comes to property. Yeah. No, fantastic. Look, it's been fantastic having a discussion. So we've got another 15 minutes available to us today. So I thought we might just open the floor to see if there's any specific questions we could answer, whether it's about creating value in a business that you could then try and recognize, or if you're on the journey of building your own property portfolio, whether you've got any specific questions for Chris, who obviously has a lot of experience inside this space.
Dave, is there any way possible where you own a business, and all businesses in my environment pay rent, and there's been a significant move due to cheap interest rates for people to become landlords or owner-occupiers by buying them, whether it's retail, commercial or office, where you don't have to fund the capital to acquire the building in after-tax? And is there a way that you can use your revenue model to invest? And it wouldn't matter if it was residential. I mean, that's why the Great Australian Dream exists, is because the Australian Tax Department gets paid before you can invest. So is there a way for people in their businesses to work smarter than having to pay their deposits in after tax? I understand in Chris's scenario where you have embedded equity and you can lift that out with no tax consequence if you raise it as debt. But how do I take my profit or my income surplus to running a business and not have to pay the tax at a business level to acquire a property? Or is that just not a possibility?
Well, definitely getting the money out of your company to lend to a trust which has the property that becomes your your commercial premises, that can be done, and you can put that on a 25-year loan if you've got enough security. You could also look at having a superannuation fund, which can also buy your commercial property, and have that in a trust. and a bare trust, and so that equity can be used, and that's not creating any tax liability immediately, and paying that rent across as long as it's commercial, and then eventually you get to the point where you turn 65, you sell everything for nothing. So again, I like the outcome to be no tax. It's if it's legal. So you get to that point where you've built your business. And even if the business becomes worth more than $6 million, then you sell your business, you get a 23 cents on the dollar tax rate, and the property, when that's sold, that's tax-free. So you can take the equity out of your super fund by just using it in the super fund in a bare trust. I think the tax that is lent, also the tax that would have been paid on after-tax money and then lent, that's hard to do, so if that was the key question. But there's always another way of doing it, or making it a subsidiary, or subscribing for shares, or and it depends on your time horizon, Bax. So.
Chris, I'm just interested in your concept of, I understand your concept of supply and demand. Do you think, and obviously I work in property finance and I've watched different markets be, cyclical, especially Queensland, boom and bust, and I've been doing this for a very long time. Do you think COVID's changed that boom and bust cycle? And do you think the affordability proposition that sits within the Greater Sydney area and remote working will see other states see the growth that Brisbane has? Because it's not just destinational anymore; it's work-life balance environments. Do you and will you see yourself investing into Tasmania as a proposition which has had substantial growth, and Queensland's having substantial growth? So do you see that adding to your philosophy as you consistently did with Bondi?
Yes, so I think there's lots of things that will change about lots of the markets around Australia, which is why specifically I stick to my strategy so I don't need to think about it. So there's some people that love researching stuff and estimating and having opinions on stuff, whereas I don't. I'd rather be out having fun, enjoying myself, doing whatever else. And so I really think the Bondi, or this blue chip strategy, I don't think anything will really change that. I can't see anything that will. And this is coming from, people like John Edwards from Residex, the head of Residex. Because on Sky News, the great thing is I could ask these guys any question. So I wasn't asking what the viewer wants, I'm asking what I want, and it just happened to be interesting to other people. And so the classic thing about affordability is most people's argument against property prices rising around the world is if wages aren't keeping up with property prices, how can people keep affording it? And so the classic answers are, look, our parents' generation had the quarter-acre block, whereas we live in small properties now. Our parents' generation, there was one income earner, now we've got two income earners per family. Interest rates in those days were, say, 10 or 20%. Now they're obviously sub 10 or sub 5. And we've got first homeowner grants and stamp duty concessions. So there's all these reasons of why generally property prices will continue. But he said the ultimate thing is this supply and demand. So we're not talking about Point Piper 50 or 100 million. We're talking about Bondi or Manly or Balmain at, say, 1.5. That's normal properties for Sydney people. Like $1 million isn't a lot for people in Sydney, is it? But if you go to, I guess, Adelaide or something like that and talk about a one-bedroom Bondi being $1 million, they're saying I can buy a whole four-bedroom house for that. So we've got clients that, I mentioned it before, is we had one client that bought his 18 and 19-year-old daughter a $2.3 and a $2.7 million property last year as their first homes in cash. Now, look, that's not a normal client, but there's plenty of those that are around doing that kind of stuff. So suddenly that father didn't care about interest rates, he didn't care about wage inflation, he didn't care about unemployment or what's going on in the economy. He's wanting his gorgeous little daughters to be in the place that he wants them to be, that he can drive to, that makes it nice and convenient. I think there's enough of those people around that will either fund the kids' deposits or will pay for the whole house that will keep those markets moving. So I think rather than try and get too clever to see where I can get 20% growth for a year or two, why not stick with 5 or 10% growth for the rest of my life? Because I'm 51 now. It's like, why have to make it more complicated than it should be? And if I do something really simple, who cares?
I was just going to ask, at what point, and I guess in what structure should a business owner start investing through a trust? Like, say, for example, they've already started investing in property, then they start a business. At what point do they, use a different vehicle for their investing, and what's the best way, potentially if they have other directors or they want to sell their business? Like, how do you consider those factors?
I'll grab that one, I guess. So I think the key one is really to have a company being the ownership vehicle of businesses, because it's eligible for grants, all of those concessions, limited liability. It can issue shares, so you can bring in new investors, etc. But most businesses these days are being sold as a company sale, so they're selling the shares instead of the businesses, mainly because people are getting more familiar with due diligence and understanding that you can sell the shares. So if you can sell the shares, you still get access to the capital gains. So most people it's much less likely they're operating their business, as in the trading of their business in a trust. But potentially the only difference is if it's like operating maybe a hotel, but even then they'll usually put a side company as the operating vehicle to protect the asset from risk. So I think the key thing is having company operating in the business, so it can do limited liability, bank debt's easier, retaining profits in it. And then if it pays a dividend, it can then pay out dividends, push the franking credits out to the beneficiaries. There are some really potentially very far-reaching changes that have been touted. That there's been a lot of tax stories around how trusts are going to be changed, how distributing income to people where they don't also get the cash, bucket companies. For the 2022 year, things are pretty much business as usual. Obviously, we've got this election coming up. Whether or not, I still remember back in 1999, everyone was talking about Keating was going to get in and change trusts. And so I think that there could be some changes in trusts. But I also remember when, people were saying, well, they're going to put the tax rates up, and everyone paid out dividends, and they didn't. So just like tax, tried and tested procedures, I think, are good with property as well. So having your company, owning it by a trust, unless you're going to go to the US, because then the US, for a lot of startups, treat trust as a flow-through vehicle and grantor trust, etc. So I think for Australian businesses where the founders are staying in Australia, that structure is absolutely perfect.
This is a question for Chris. So being an accountant myself, P&L balance sheets.
So you've got the non-emotion sorted, so that's a plus.
But the emotion is coming into it. So you mentioned your strategy is buy and hold, buy and hold. You don't want to sell because CGT will crystallize and there'll be some tax to you. Your rent, assuming, will be paying for part of your gearing, so your debt will offset your rent. Presumably there may be some negative gearing, so you might have to find some cash from somewhere to settle that. My question comes from more of a lifestyle perspective then, because you've got all this value on paper. How do you liquidate part of that to try and then use that for your lifestyle? So if I want to go on a fancy holiday or buy a Ferrari tomorrow, but it's all coming in and going out to the bank or not being liquidated to fund anything, do you have any thoughts or strategies on how you can actually free up some cash flow?
I've spent my whole life doing it. There's another book I wrote a couple of years ago called How to Live the Life of a Multimillionaire Without Being One, which you can get on the website. That's got part of it. But this book has got part of the answer. And how I got the Porsche at 24 was the same way. So basically, most people think you've got to sell stuff to get the cash. So let's just say you bought a property for $1 million. It went up to 1.1 million. You sold it, you've made 100 grand, but you've got to pay the capital gains tax and stuff like that. If you then went out and say, first of all, you've got to pay an agent, say 25 grand, then you might pay tax, say another 25 grand, say, and then stamp duty to rebuy another property is about 50. So your 100 grand's completely gone. But let's just say you had 20 grand left. If you spent that on a holiday, that would be okay, wouldn't it? Because you bought a property, you made a profit, you paid the tax, and you've done your holiday, but you've got no more asset left. Whereas if you went to the bank and said, right, my property's gone up 100 grand, can I borrow 80%? Now, these days, the hardest thing is serviceability. So this is assuming that you can show serviceability to get that. Say if the bank gave you that 80 grand, potentially, so hypothetically, because I'm not here to give you advice, what you might be able to do is you can go and spend that 20 grand on that holiday you wanted. You've then still got 60 grand left, which would be non-deductible debt. So you'd want a separate loan for non-deductible debt. And you've then got 60 grand, which technically would buy you then depositing costs on another 200 or 300 grand property. So the negative people would say, or the accountant in you would say, yeah, but I've got 20 grand of non-deductible debt that's capitalising interest. But I would say, yes, but you've still got a $1.1 million property plus another 300 grand property now. So you've got a $1.4 million property. You've paid no tax, you've paid no agent, and that property is going to be rising by much more money than the small amount of interest costs. And then later on the strategies, so this is what I'm doing now, if you can't prove serviceability, what I'm doing to the banks now, so say I had 10 million of property and 8 million of debt, so 80% geared. In time, that property rises to 15 million. I still can't service with the bank because I haven't got a job. I then go to the bank and say, you only needed 10 million of security, you've got 15 million, so release 5 million of security to me. And I've just done it, and so they will do that. So then you've got 5 million of debt-free property, which either you could sell one and you get 100% of the proceeds, less your tax. Whereas if you had it still with the bank, they might only give you, they might get you to repay half your debt, half your mortgage. Or you can go to a second tier, or not a second tier lender, a third or fourth tier, or even a private lender to say, right, okay, here's $1 million property. I want to borrow 500 grand or 250, and you could probably borrow it for 6 or 7% to a high net worth individual that's more than happy to lend 25 or 50% on a $1 million blue chip property. And again, you're capitalizing interest, but I'd rather pay 5% compound interest than I'd pay 50% tax. Okay. So hypothetically, could that work, David? Yeah.
Well, I think the reality is, you know, you're paying a little bit of extra income tax on not getting that deduction, but you've saved the $80,000, and more importantly, the entire $1.1 million is growing at 5%. And
be friendly with your banker, then. That's.
Well, I think it's all about capital allocation. It's understanding, you know, what the cost of money is, what the growth of the asset is, understanding, you know, is it going to grow if I put another $20,000 into the property? The world runs on good capital allocation, being able to move money around and put it in the right speed, direction, and increments in your life. And that's the secret to building that $100 million business or $100 million property portfolio.
The four walls of jail, which we call the main tier banks that have held the Australian public to ransom forever and fear-mongered everybody else, ironically, were the ones that were punished the hardest at the Royal Commission, where you were quoting private sector funding at 6-7%. There's secondary mortgage market firms in our language, because it doesn't have ANZ or NAB or anything. They're around 3.5%.
But this is assuming if you've got zero income.
Yeah.
So they still want to show some serviceability.
But it's still, you know, below 5s.
Yep.
And the other side of that is with cash rates moving up, you know, they're projecting 2% over the next 2 years. The banks are going to move their rates. And ironically, the private sector won't move its rates because their depositors are already getting a higher cash rate than the retail banking sector, which, you know, you get 0.1 or 0.4. So I think there's going to be a heavier flight to the non-banking sector because they won't have to move rates was the same as the RBA and the retailers.
Oh, look, I think there will. I think there'll be more wraps, and I mean, we've got all these first loans and payday loans and all that kind of stuff. I think there'll be more ability to get funds. But one thing on your question before is I wouldn't go to my banker and tell them what I'm going to do. So I'd be going to a mortgage broker to start with because that's an intermediary. I'd be having a good accountant that understands my numbers inside out to make sure I'm not doing something stupid. But it's more with the banks than my banks know exactly what I'm going to do. Like, they read my book. I've done seminars at most of the major banks anyway, so they know what I'm going to do. But when I go there, I'm not going to them saying, can you lend me money for me to go and spend it on lifestyle? Or can you lend me some money and I'm going to capitalize the interest on it? They know exactly what I'm doing. But to tick those boxes, I don't want to be telling them exactly what I'm doing. So again, it's not saying a lie. It's telling them the information they need to know without telling them any more. But I've said it all on Sky News, CPA Australia. It's black and white. Everyone knows what I'm doing.
No, fantastic. Well, I might just wrap things up for today, given we're just inside the time allocation that we've got. I've found it very educational and very interesting. If you could possibly, before you go, we do have a feedback form that we've put on each of the sheets. And if you do want to have a conversation with any of us from iKeep, Hall Chadwick, or your empire, just tick the box down below and we'll reach out to you in the next week or two just have a conversation, can discuss maybe more one-on-one, something that's suitable to you. Also on your chairs, you'll see that there is a gift from the team at Your Empire, one of Chris's books. So again, if you have enjoyed the conversation today around that, there's some more details sitting inside there. Now, we have catered for absolutely everybody, so feel free to grab some food on the way out because there is plenty there. And thanks for taking the time to come up and have a conversation today. It's been wonderful hosting, and we look forward to speaking with everyone in due course.